My next guest today is Savita Subramanian, Head of U.S. Equity and Quantitative Strategy and Head of Environmental and Social Governance Research at the Bank of America. Welcome.
Great to be here. Thanks for having me.
Savita, I wanted to ask you first off why you think there's been so much interest in ESG investing over the past few years.
I think it's a great question, and I think part of it is just that people started to figure out that it works. And really, here we are is an environment where ESG investing has been a proven way to generate alpha. So a lot of our work, 5 or 6 years ago, focused on really trying to see whether these attributes actually added to company performance. I work on Wall Street, so what I write about is, how to generate excess returns for our institutional investor clients. And what we found was actually very encouraging in that, a lot of these non-financial attributes are actually more predictive and more powerful in signaling returns and risk than a lot of the things we learned about in Finance 101. And I think that's where we are in terms of the adoption of ESG and, these sort of non-financial signals as ways of selecting securities. I think also, just quickly, this isn't a new discipline. Investors since day one of investing have been thinking about governance risks, environmental risks, flight risks of top talent at companies. And now what we're doing is just sort of more formally integrating it into the investment discipline.
Now, I want to go back to an interesting point you made about how some of these leading ESG indicators, these so-called ESG red flags, could actually be more predictive of how a company or a stock does than some of the more traditional financial measures. And it's interesting because I think there's a perception that, you could either target ESG or you could target profits. And I wanted to ask you which, ESG factors and considerations appear to be the most important when it comes to a company's financial output.
Yeah, great question. And the answer is it depends. So what we found is that certain sectors have more material issues than others, and certain regions have more material issues than others. So for example, for companies within technology or biotech, companies that rely on really smart and innovative workforces, we've found that employee satisfaction, training, things that will guard against flight risk are really critical in terms of determining performance of a company relative to its competitors. For a company like financials, I think what was really interesting to me, having worked in the financial sector for almost, for over 20 years, ahead of the crisis, what we found were that a lot of the governance and social factors for banks started to deteriorate in, 2005 to 2007, a couple of years before the financial crisis. So we found that governance was a very critical determinant of risk within the financial sector. And in hindsight, I wish I had been really focused on ESG back in 2005. For other sectors like energy or materials or capital-intensive sectors, we found that environmental concerns are more important. Safety of workforce, for healthcare product safety is a very important factor. So, it really depends on the business. But what we found in our quantitative and fundamental analysis is that the way to use ESG is specific to a sector. It's not that sort of one size fits all type of strategy that might be used. So the devil is really in the details.
And when it comes to the details that investors are looking at, what are the main ESG categories that investors are most interested in?
So, I think that recently environmental factors have taken center stage. And this is because, the world has made a fairly aggressive commitment to getting to net zero within the next few decades. And the time is now. And I've heard, others on your program talk about this, and I think this is really the critical issue. Now, today, I think the mechanics of getting to a lower greenhouse gas emissions world it's getting complicated. And what we're hearing from companies is that it might not be as easy as it seemed on first blush. So I think environmental factors, companies that have set targets to reduce emissions and are meeting those targets because now we can actually track progress of companies. So it's interesting, you know, a few years ago, everybody set targets. Now we can actually track their progress towards getting there. Governance, always important, but I think that's the most well understood part of E, S, and G. Social factors, I think, are really taking center stage now in light of this rampant labor inflation and a tight labor market. So when you think about, you know, a happy, stable workforce, that might be paramount in today's environment where attracting and retaining talent is getting costlier and costlier. So, you know, I think that the E, S, and G all have roles in the investment landscape, but probably today, environmental and social issues are really taking center stage.
Now, Savita, you just mentioned a wide range of issues that investors are looking into and interested in. But do you think they have enough information right now from companies to make informed decisions about where their money is going based on those factors and trying to follow a specific set of values based on those ESG factors too?
Yeah, I mean, it's such an important question because disclosure and transparency and being able to compare two companies on an apples-to-apples basis is really important. And I think that's where regulators are coming in and saying, okay, here are the things that every company needs to tell us as investors, and this is the way you need to show it to us. So I think that's really where the regulatory world is changing. And, you know, just on a daily basis, it's hard to keep up with the headlines around, you know, what various NGOs are proposing. But I do think we're in an environment where we need some type of standardized disclosure system so that we can make informed comparisons between companies. I think what's hard is that smaller companies don't necessarily have the resources to disclose as much information as a larger company with a specific ESG team. So that's where the challenges come in terms of helping companies understand how to disclose and maybe even helping them with the process and the resources involved in measuring and telling investors how they're doing. But, you know, to your point, I think the amount of information that we've seen over the last 5 years has been explosive in terms of what companies are telling us, because I think that companies realize that if they don't tell investors what we want to know, we're not necessarily going to assign the appropriate cost of capital to their stock or bond.
Savita, you brought up a point that I want to come back to, which is some concerns about whether smaller firms can actually hold up and, you know, comply with these disclosure requirements. That's something that's been mentioned by many policymakers and lawmakers in Washington who are concerned about these ESG disclosure rules, predominantly Republican lawmakers, but several industry groups too. And I was wondering how the SEC and other regulators should try to strike the balance between giving folks the information that they want and making sure companies are actually in a place to be able to provide it.
Yeah, I mean, I think it's a complicated problem, and you know, I think the issue is, I think that the solution might be aided immensely by coming up with a standard set of metrics. So similar to, you know, accounting standards. Every company that is publicly traded is on the hook for disclosing their financial information in a fairly formalized way, and I think that would be the model applied to certain components of ESG investing or ESG attributes. The problem is a lot of this stuff is fuzzy and hard to measure. So that's where the latitude comes in terms of giving companies, you know, some berth in terms of how they're measuring these factors. You know, even today, I think what's interesting is that corporates have really taken a leadership role in disclosure, even smaller companies. So we've seen, you know, even recent IPOs, companies have published corporate sustainability reports alongside their financial statements. And I think we're getting to a point where, you know, if investors want information enough, companies are going to figure out a way to give it to them. And that's really what we're seeing happen real time. But you know, one of the things that we see a lot is that ESG investors tend to have a very large company bias because that's where the disclosure is the strongest. And we fear that that's missing a lot of these great companies that just don't have the bandwidth to tell us how great they are. So I think that's something that we need to really thoughtfully figure out.
Savita, my last question for you is from our audience. It's from Mark Anderson, a senior government relations advisor at Kelly Dyer. Mark asks, how much should ESG factor into lending?
Into lending. So, I think it's a really interesting question. And I mean, the question is, should green bonds even exist? Should labeled bonds even exist? I mean, the idea of carving out a certain portion of your capital as green or labeled is a little bit, unsatisfying if you think about this from a more holistic and systematic perspective. But I do think that what we've seen is, the trackability and the traceability of funds, the intention, the idea that if you issue this capital, it's additive to what you're already doing, and you couldn't have used cash in other places to fund these themes. I think that's where it becomes a really enriching source of lending and capital allocation. I mean, at the end of the day, I think we're going to get to a point 10 or 20 years from now where we don't talk about ESG. Everything is ESG. We think that we've incorporated all of these aspects into every bond that companies raise, into every practice they make, and it's just sort of firmly embedded in their operational expertise. Right. But we're probably not there yet. So in that transition, I think that the role of labeled bonds is a really critical source of capital.
Certainly. Thank you, Savita Subramanian, Head of ESG Research at Bank of America Global Research. I appreciate you taking the time.
Thank you. Great to be here.